Hello, this is Hall Martin with 10 Capital. Thank you guys for joining us today. Appreciate you sharing your time with us. Today we're going to have our next in the Edu E-Series, and the topic today is preparing for your fundraise. As we go along, if you have questions, go ahead and put those in the chat box or the Q&A panel there, and we'll answer those as we get to them itself. So let's go ahead and kick into it. So the first question you always want to ask when you get ready for a fundraise is, are you venture fundable? And these are the things venture capital in particular are going to look for, but also angels and family offices will look for them as well. And the question that they really want to see is, number one, do you have recurring revenue in your business in some fashion or form? It may not be 100% recurring, but if some portion is, that's a tremendous value to them, because it gives you a predictable revenue stream, and that really helps on your model. Next is, are you a platform-based approach? In other words, are you taking a platform-based approach to your product or service, or are you selling customized services or one-off products? The more you're a platform-based, the more they're going to be interested in your deal. Next one is, they're going to be looking for some data centricity here. That means your business generates data and uses data. As you go along, what you'll find is your first order is to sell your product or service, but second order is to sell the data from that process, both the data you're generating and data that can be used for other decision-making processes. It may be hard to do this from day one, but if you make that a roadmap decision, we're going to put our first product in place or get our platform up and running, and then in the year 3, we're going to start selling data or make data a part of what we're doing. And in the process of the first 2-3 years, you're actually collecting data from those who are using your product is one of the best strategies, because now you'll have something in hand based on users of your product before you actually have to actually sell it. The fourth thing they're looking for is a strong team. Do you have people on the team that are covering all the basic elements? Someone building it, someone selling it, and also if you're in a domain that requires specific domain knowledge, do you have that on the team as well? The next thing they'll look for is fast growth. They're looking for high growth, and at minimum is 50% year over year. In the very early days of a business, below 500K, that should not be hard to achieve. You're starting from a very low revenue point, and so to increase by 50% or more year over year is something that they will look at. When you get past $1 to $5 million, then growing more than 50% year over year or even doubling can get harder at that stage. But at the very early stage, it shouldn't be hard, and you should be able to walk in with some substantial growth numbers to show you are in movement there. Next is, you look for a large target market. Are you targeting market over $1 billion? If you are, well then this is going to be exciting to the investors. And they're adding up all these elements to see how many of these boxes you check mark. And the more you check mark, the more you're going to be able to get interest from investors for your deal. Again, if you have questions, go ahead and put them in the chat box or the Q&A, and we'll answer them as we go along. Next is preparing for your fundraise. There are 3 steps you need to do before you actually go and launch your fundraise campaign. The first is prepare your business. The first question you want to check is making sure that your team, board, investors are all on board and aligned with the fundraise campaign you want to run. They may not be all aligned with the specific details of the structure or the amount, but fundamentally they agree we should be going down that path. You don't want to go down that path alone. And it certainly shouldn't come as a surprise to them when you launch your fundraise campaign. Next is complete your investor documents. This will help you tremendously in the campaign if you have the basic documents already built, rather than scrambling around when an investor asks for them. And the fundamental documents is your pitch deck, your financial projections, and your term sheet. These are core 3 documents that will come up sooner rather than later. Eventually, you'll need a full due diligence box, or what they call a data room, and you'll need other documents. But on the first day of going out to pitch, you want to have those 3 documents available. And next is build your investor network. Make a list of investors you're going to contact, and include existing investors, people that would be of interest to invest and would also have contacts they can refer you to as well. And one thing you can do is set up an initial meeting with those guys and tell them you plan to launch a raise in 3 months. Not now, but in 3 months. And this is a great way to open up the dialogue. No pressure, no obligations. All you have to do is just listen and start to learn. And that's a great way to kick off a fundraise campaign is to start talking to people that you're going to do this in the near future. So some of the documents we talked about you'll need are a pitch deck, financial projections, and a term sheet. And so for a pitch deck, you need 10 to 15 slides covering the problem you're solving, your solution and product, competitive advantage, business model, team, financial projections, fundraise amount, and the exit you envision. These are about 10 documents that should be in every pitch deck that tells the investor what you have in mind, what your vision is. And the document should be aligned in some way or form. So the financial projections thumbnail should include the fundraise amount you are targeting. This can be a little bit challenging because you're always modifying these documents and changing your plans as you go along. And at some point, investor may call you out because there's a mismatch in the numbers or in the slides, that one slide doesn't agree with the others. You always want to make sure that they all jive at the end. Next is financial projections, also called the pro forma. And this gives an investor an idea of what you plan to do with the funds and how you see the company growing. Investors glean a lot from the financial projections, and there's two levels. One is the high level and the other is the detail level. At the high level, when they see a financial projection, for example, that says year 1, year 2, year 3, they often discount that because you don't have specific dates. If you don't have specific years on there, then they're walking away thinking, well, they're still thinking about what they might do. They aren't really committed to this plan, so it weakens the plan quite a bit. You also look at the numbers. If the numbers are all round numbers, $1 million, 500,000, then they walk away thinking they really don't know their numbers very well. They're just guesstimating what those numbers are. If, on the other hand, they see very specific numbers and they see numbers driven off of the per unit sales or per customer sales or what have you, and there's some logic to the pro forma, then it gives you more credibility because you know your numbers and you know what the, for example, if I generate 5,000 leads, what percent of those will convert and how much does that cost? If you know those numbers in good detail, the investors give you credit for having shown that up on the financial projections because you know what you're doing. And third is the term sheet. You need to outline the terms of the investment. You don't have to have the specific term sheet in hand to hand out. Investors aren't going to ask for that up front, but they do want to know what kind of deal structure it is, what some of the specific terms you are considering. And you need to have this somewhat thought out before you launch. You can modify or adjust it as you go along, but you need to have a proposal up front so they have something to deal with, as opposed to we haven't figured that out, which means they can't do anything. If you have a particular equity deal structure in mind with a certain valuation, at some point you need to put that out there so people get a sense of where your head is at and where theirs at and how you might come together on it. So the next thing you're going to need is an entity. If you're raising funding and you haven't been out there before or you just started, you need to have a legal structure already set up. Investors cannot invest in your deal unless there's a legal entity in which they can invest into. And so if you haven't done this before, the first thing you want to do, I recommend, is start with an LLC. It's a limited liability corporation. And you continue with this until later rounds of funding, in which case the investors may want to see a Delaware C corporation entity. But you don't jump to that straight up because that can be quite expensive. Venture capital investors at some point will want to come in and they will demand a Delaware C corporation. And number one, it's the gold standard out there. Number two, all of their investment documents are set up for it and they're not going to change it now. And the key here is to tell your investors that you'll convert to a Delaware C when the time is right, and it's contingent upon funding as well. They have to put money in to justify the expense for moving to a Delaware C. This is the standard way of doing it that keeps the costs low. Some businesses start, they go a ways, and then they don't quite make it. And so an LLC is very easy to shut down. A Delaware C is a little bit more. It's very easy to move from an LLC to a Delaware C. It's very hard to move from Delaware C back to an LLC itself. So let's check to see what questions we have here. Let's see. So the first question is, do you need an attorney to file an LLC? And the answer is not necessarily. In most cases, you're just simply filing a very simple document to the Secretary of State at your local state government. articles on the LLC, you can do so, but it's not required. And in most cases, it's just a few $100s to open up and have a legal entity. So it's really not hard to do. So not necessarily. Now, if you move to a Delaware C, you would definitely need to actually get an attorney involved in that, because there's a lot more nuance that goes into that. And then the next question is, what is a Delaware C corporation? And that's basically, a C corporation means you're a formal corporation and you're filing in the state of Delaware. And people have chosen Delaware because it is the most investor-friendly state of all 50 of the U.S. states. It's got the best terms, it's got the most protections for the investor, and so the investors are wanting to be on that. And then, so it has become a standard among venture capital and angels and other groups to get a Delaware C corporation, because you're going to get the most protection. And it's also, all their documents are built into that as well. So it's just simply filing in the state of Delaware, which is not, you don't have to be in Delaware, you can be anywhere to do so, but you have that Delaware C designation, and it provides the formal structures of a corporation that go around it as well. So thank you for those answers, and let's continue on. Let's go back one. So what deal structure should you use? There are two primary deal structures for your startup fundraise. There's a convertible note, and then there's equity. A convertible note is a debt instrument that converts to equity later. If you want to use straight debt, then you should use a promissory note. So convertible notes are meant to convert to equity at some point. They come with three terms on there: an interest rate, a discount rate, and a cap rate. The interest rate is what does your money earn in the form of interest while it's in debt form. Discount is when you give the investor additional discount in the conversion to equity, because these investors are coming earlier than everyone else. Therefore, they should get some number, say 10, 15% more, because they have spent more time in the deal itself. Then cap rate just tells you how it will convert into equity, which will be dependent somewhat on what the final valuation is when it converts. So it's a debt instrument that converts to equity later, and they often have maturity dates on them, 3, 4, 5 years. So if there is no follow-on finance that converts it to equity, then it will convert to equity at the cap rate at that date, 3, 4, or 5 years. So that maturity date helps you move to equity at some point. So on the equity side, this is really a document that gives you ownership rights into the company. And the ownership is set by the valuation of the company. And there are other terms can be put in there around board seats, voting rights, pay-to-play terms, liquidation preferences, prefs, and so forth can be brought into it as well. So those are the standard that most people use in moving to equity. Is you want to put out there the key number that people are always asking on equity is what's called the pre-money valuation. What's the business worth before we put our money in? And for those who are not familiar, pre-money is the number, say $4 million. If you're investing $1 million, that's the investment. And then post-money is the pre-money plus the investment. So 4 plus 1 equals 5. So post-money would be $5 million. And investors get the investment divided by the post-money. So 1 divided by 5 gives them a 20% ownership rate. And so what you'll find is that the investors are pushing the valuation down to get a bigger percentage, and the entrepreneur is pushing the valuation up to keep more percent for themselves after the investment comes through. So let's go and see what other questions we have here at this point. So what is the most common deal structure you see out there? Well, for early stage seed deals, convertible notes are the most common. And that's because equity, you really need a lead investor to launch an equity term sheet. And someone has to come in and put the diligence on the deal, do the valuation, negotiate the terms. And from very, very early stage, there's just not a lot of people interested in that. So people use convertible notes for the very early stage. When you start moving to Series A rounds, you'll see people will start with convertible notes and they'll switch to equity when there's the right investor coming in the door. And as you go later stage, they'll move more to equity as well. So That answers those questions there. And let's move on to the next one. So standard startup metrics apply. What does this mean? Well, I see a lot of entrepreneurs coming in and they've got a great idea. They've got a great business in their head, and they always have a great vision about where it's going to go. But in the end, investors are not always investing in a vision alone. They're investing in your proof of executing on it, which shows up in the metrics. And so standard metrics apply means you have a platform set up with users on it and line of sight to revenue, and we can calculate metrics on it. If there's no platform, there's no users, no revenue, then it's very hard to calculate metrics. You can forecast metrics, but that's not the same as having standard business metrics. These are actual key performance indicators that show your business is going in the right direction. Revenue is increasing, users are increasing. You have certain factors around cost of customer acquisition and lifetime value, and you're able to measure those things. But those are only real measures if you have real users with real revenue. And so we have a fair number of people coming in with great ideas, but no metrics. And up front, it's a great presentation. There's a lot of interest, but very few checks get written at the end of that, because when they go to look for the metrics, they're not there, and then they start to lose confidence. The fundamental thing behind revenue is you have to prove market validation and product validation when you raise funding. The user likes the product and they will pay for it, and you have to demonstrate that. Some people use crowdfunding campaigns to demonstrate that. Some people use test customers or beta customers or anchor clients to prove that. But at some point along the way, you're going to have to demonstrate product and market validation, and you're going to need to put metrics on the table to convince people to write a check. So product validation and market validation, let's talk more about that. So investors look for evidence that the product works and someone will buy it before they move further into due diligence. So if you have a round of beta users on a prototype or a minimum viable product, what you want to do is get quotes and information from those users to show the value that they're getting from it, what they think about it, commitment that they're going to use it, commitment they're going to pay for it. And so you want to have enough strength around this to show that there's actually a viable customer base behind it. Another way to do this is to use anchor clients. Go and do 1, 2, or 3 clients or customers, charge them a price, some particular custom fee for having you build a customized version of your product for them. This is tremendous validation because it shows that there's maybe a bigger customer out there putting bigger dollars down because you're solving a problem for them, and then now you have a reference once you've done that. Beta users are great to show that the product works and there is customer interest. If you don't have anyone paying, then you often end up resorting to what we call pipeline metrics. These are people that are signing up to test your product, and you have lots of people signing up and they're talking about big numbers, but they haven't actually used it or they haven't actually paid for it yet. But you can show interest by showing a sales funnel with a pipeline of prospects coming in and what they might do with it and what they're wanting to solve with it, and then seeing how many convert through your process as well. Let's go to the next one. So the next thing you need to think about is the importance of milestones. When I talk to a lot of startups, I ask how much their raise is, and they tell me numbers like $5 million or $10 million. What they're really saying is, I want to, over the life of my business, raise $5 or $10 million. But what you need to do is break these down into tranches and stages. There's pre-seed, there's seed plus, there's Series A, there's Series B. Those are different stages along the way. And you want to take that $5 million and break it down. The standard numbers we see out there for pre-seed are $250,000. For seed is $500,000 to $750,000. For seed plus is another $500,000 to $750,000. For Series A, they're raising $1 to $3 million. For Series B, they're raising $5 to $15 million. And so the idea is you're taking your fundraise and breaking it down into smaller steps. And so the key here with milestones is you want to raise when you have reached a milestone and you know what the next one is. And so you should have a trigger point, and the 4 trigger points are something to do with the team, the product, the sales, or the fundraise. So if you've hired a new team member or brought on a new board member or a new advisor, that could be the trigger that now's the time to go raise funding because we have a complete team or enough of a team to go after it. If you bring the product to a new level, say you went from, you now have a beta version that's working in the hands of beta customers and it's working well, now's the time to launch a fundraise. Or maybe you have an MVP, minimum viable product that's out there and you want to actually use it to go raise funding. This is a great time to put a fundraise campaign together because now you can tell the growth story. Sales, if you've achieved a particular sales revenue run rate, 10K MRR, 100K ARR, whatever that number is, you've achieved a sales milestone, and so now you want to raise funding to carry this forward. And then finally, a fundraise. If you land a big investor, for example, a lead investor, you have the first 20% of your raise brought in the door already, that's a great time to launch a fundraise campaign because you've done the hardest part, and that's found the first investor for your deal. So like I say, you want to have a trigger to launch your fundraise campaign, and then when you go to raise campaign, you're going to talk about the use of the funds, and that's basically the second milestone. What do you plan to do with the funds, and what do you plan to reach with it based on the funds you're raising and the time frame you're giving yourself? So that's the importance of milestones. So next one is who can help with your fundraise. And so you want to build a network around you to help you with the fundraise, not only those who can put money in, but also those who can help you find others to come in and those who will support you. In the early days, family and friends, while the money may be very small relative to venture capital, it also shows a lot of support and a lot of commitment that you have built into your business. Coworkers that you've worked with before, service providers, lawyers, attorneys have put time and effort into your business in return for equity, shows their support for your business. And then on the investor side, there's angel networks, VCs, referral partners, local family offices, national angel networks, national VCs. These are all different groups you can go to who can help you with your fundraise. In every case, you're getting not only dollars, but you're getting support. It could be networks, it could be expertise, it could be getting advice, but you're getting help with your business beyond just the dollars that they hand you. So with that, if there's any other questions, please ask them now. Those are the key elements that goes into getting ready for a fundraise. If you need help with your fundraise, please contact us at the email on the screen, info@10capital.group. We'll be glad to talk with you about it and see what we can do to help you get ready for your fundraise. We do help people with documents and with deal structures and with other elements of it. So happy to help you with it. So we have one question here. What are some key factors in determining your company's valuation? Well, so the key factor in the company's valuation, in my mind, comes down to 4 elements: your team, your product, your sales, and your intellectual property. These are the key values you see in early stage startups. And the more you have of each one of those things, the higher your valuation is. The key with determining your company's valuation is, what you have in the company today gives you today's valuation. What you will have in the company tomorrow will give you what will be tomorrow's valuation. No fair taking tomorrow's valuation and applying it to today. I often hear startups talk about how one day they'll have $10 million, so therefore they must be worth $30 million now. Well, no, if you have $10 million today, well, then you are worth $30 million. But if you don't have $10 million today, let's say you have 200K, well, then you'll be worth a lot less. And so you have to apply what is in the business today to your valuation. But look hard at the team you built, look very carefully at the sales revenue you have so far, and then look at the product you built, what stage it's in, how much value is there. And then finally, look at your intellectual property. The key thing you have to do in valuation negotiation with an investor is articulate all the values in the business in the 4 areas we just talked about. Those are things in the business itself. It's often the case that entrepreneurs argue their valuation based on just how much value, how much equity they want to own at the end of the process. but that argument falls on deaf ears. You have to argue valuation based on what's in the business itself. And so before you go out to raise funding and have the valuation discussion, think more carefully about how that argument might go down and what key values you would want to put on the table to convince the investor your number is the right one. Next question is, what if you're not venture fundable? The key answer here is if you don't tick all the boxes that we showed on that slide of recurring revenue, platform-based business, etc. Maybe you have some, but not all. Realize that there are investors out there, maybe not venture capital, but rather angels or some family offices that are investing in things for other reasons. They may be investing because they want to foster the technology you're developing, or they're an impact investor and they really want to see you running an impact deal, providing a give back to the community. And so I would look for non-venture capital and look for other things out there that might give you an edge in raising funding. Impact investing is one, fostering technologies is another. And there are some investors that will just invest based on the quality of the team, and they don't put as much weight behind those factors we showed as far as recurring revenue because they just believe in the team. So there's other things you can emphasize primarily to angels and family offices that will get you past the venture fundable question, and you want to emphasize those in your presentation as well. Well, appreciate you guys joining today. Are there any other questions? It looks like we've answered them all. Appreciate you joining us today. If you'd like to discuss with us further about any of these topics, feel free to reach out to me. Glad to answer your questions by email. Just shoot them over. And thank you for joining us today. Hope to see you back for another EDU presentation soon. And with that, we'll close it out.